Unlocking things beyond the Magnificent Seven. I'm sure you all have heard of the Magnificent Seven. So he's going to focus on hidden gems and critical natural resources. And he'll tell us, which I always am loving to hear, is it time to sell the Magnificent Seven? That would be good to know, right? And Robert has over 40 years of Wall Street experience. He was a VP of a major investment banking firm, and he's a manager of the top-rated mutual fund by Morningstar, which we have. And he's the first analyst that did identify the Magnificent Seven in 2023 before a 100% move up in price. And so he's also the president of Singular Research, and it is top-ranked hedge fund manager also. And our fund, I get asked a lot, is in the HFRS index. So that's a good perk to know. And we at Singular, we do have 110 institutional clients with 60 billion in assets under management. And Robert is the president and CEO of the Argonaut Partners Fund 2000 LP, and it is in the top 4% of all the funds. I'm an investor. I love being an investor. The fund has doubled for me, and I will always be an investor in the fund and with our company Singular Research and the Argonaut Partner 2000 hedge fund. So I'll introduce to you the president and CEO, Robert Maltbie.
All right, thank you, Louisa.
I was hoping she could say top 4% a couple more times in case you didn't catch it. Thank you for coming. So we're going to jump right in. We've got our director of research here remotely as well, Chris Sakai. Hey, Chris, can you hear me?
Yes. Hi, Robert.
Hi, Chris. He emceed our show earlier today, where we had our institutional clients also on board. So, Chris, can you take us to
Just so everyone knows, I will be the one changing the pages while Robert mentions that.
Okay, I don't really need it. Massive steps you take for preparation right ahead of time. Okay, so Chris, let's go into the first idea, the Magnificent Seven, and why it might be time to step away. Oh, thank you. How did they get back there? Whoops. Okay, I found it. Okay, I feel much better now. Okay. Firstly, we want to cover a little bit out of order the three ideas we talked about last week. So you pay extra attention to our three ideas this week. Now, in context, they don't all work out this way. Sometimes they go down. But last conference, last dinner, we were really definitively at a low point in the market before the tariffs to the sidelines and said, oh, we're going to put a stop on all that. Then we had this nice massive rally. So we'll come back to those, but we talked about three ideas we liked a lot, and they've all done quite well.
Robert, is that in the PowerPoint?
Oh, the three ideas is a chart. I think it says it's part of the charts I sent, part of the slides I sent you. I think it says something really nebulous like composite 51 or 61. But no matter, I'll jump in here at the interest of time.
Is it this one?
Yeah, there it is. I don't know if you can see that, but this will pay for your dinner for sure. So at the aforementioned dinner meeting, we had Flowtech, which we spotlighted up 129% in a month. Believe me, I wish this happened often. Serve Robotics up 98%. Yeah, I think congrats for those that stepped into those. And Opportune Financial up 46, and the S&P didn't do bad itself, too bad, up 12 point something or other. So it was a good run. Again, we were poised, we were way oversold, and it doesn't always work this way. Believe me, this is like a year's worth of returns in a month. But now it's the hard work, the easy money, the rebound has happened. Now what do we do? So Chris, go back to the presentation. No, that's there we go. Okay. So the ultimate mean reversion and why the time is now. The S&P market concentration has been immense, unparalleled. The aforementioned Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, NVIDIA, Meta, and those keyed up Teslas. I hope you didn't get keyed, but it's part of the seven. They make up 30% of the market value, and they're only 1.4% of the composite itself. So imagine that concentration. It's created some distortions besides size in the way the market looks. Scroll down a little bit, please. Now, some of you market veterans might remember other periods of peak concentration, the dot-com era, and the Nifty 50 going way back. So here we have it. We look at PE ratios for a quick valuation, how cheap or how expensive. And we also like to factor in the other part of the equation is the growth rate. So here we look at the Magnificent Seven, currently 47 times earnings. Believe me, that is high. Expected growth, 13%. The rest of the market trades at about 16. That's the mean. The average is even lower. With expected growth that is nearly the Magnificent Seven at a price that is about a third. That's the magnitude of the distortion. The aggregate is when you add back in to the S&P, the Magnificent Seven. So what we've done here is we've dissected it and then we put it back together. We have something that looks expensive. People look at our markets and, wow, 23, 24 times historical average is 16, 17. You do the math, that's 30% above the average. So scroll down a little bit. The equation is one of overvaluation. Now, these periods of overvaluation can go on a long time. And there's a saying that says, the market never, the market will outlast your capital, even though you might be right, you might not be there because it could take some time. So you really need a catalyst, some group, some event that's going to make this thing really accelerate and happen. I think we're seeing a combination of that now. So this Magnificent Seven has been carrying the load for the earnings and everything since the last several years. Now things are starting to change. The earnings estimates for the rest of the market are going higher. Their profit margins are going higher. Their cost controls have started to kick in from the prior cycles. And they're getting benefits from increased spending in reshoring. All these announcements about these companies responding to the tariffs, they're benefiting a lot of these companies. Also participating in the AI infrastructure and in defense. Defense is going to get some money too. Scroll down a little bit. So performance dispersion merely shows that, okay, over the last couple of years, it's all been about the Magnificent Seven. 70% return, where the equal weighted S&P way behind, about 11%. this has caused a lot of confusion with in passive investors that buy ETFs, where they're buying, investing in the S&P, and that's done well, even though it looks overvalued because of the Magnificent Seven. But equal weighted counterparts are lagging because they have less of Magnificent Seven in the momentum part of that. So here's some of the things that are transpiring now. Well, firstly, you get a mean reversion at some point. You need a catalyst for that. But right now, the cards are lined up pretty correctly. Secondly, you get a broadening out. We're starting to see that now with the factors we talked about, broadening out of the earnings of the other part of the market. And historically, we know that these periods of concentration end in a rotation into value stocks and a broader participation. So scrolling down a little bit, the strategy we're going to talk about is what to do now, and rebalancing. What should you be looking at? What's going to work? So if you can scroll down a little bit more, I think we have a chart here that kind of hammers home this point. On the left side is the Magnificent Seven. The blue bar represents the valuation, and the yellow bar represents the growth. And this growth is it's a little confusing, but the growth is on the right side in a different scale. But you've got 13% growth and a valuation that's way above. You compare the blues to the yellows. That's the way to look at this. You have a lot of divergence here. If you look at the right side, that's 493. You can see the blue is way below the yellow. That shows how cheap the rest of the market is. Can you scroll down a little bit? This is another way to look at it. You have what's called, I'm going to get too wonky here, but you have what's called a PEG ratio, which is comparing both sides of the equation, the PE ratio, and then the growth rate of the company, because there's more than just a PE. What are you paying for? What kind of growth? So the gray bar is the historical average. The blue bar is the Magnificent Seven. Now this isn't just scaled logarithmically. And the green bar is the 493. So based on the historical valuations, the blue bar is overvalued by about 40%. The green bar is undervalued by about 60%. So definitely you want to start thinking about rotating into the green here. Next slide. Rebalancing. And that would include if you own ETFs that are just S&P, because they're skewed by the seven. They're capitalization weighted, which means they are fully impacted by the Magnificent Seven. So back to the catalyst, we're looking at peak earnings growth with the Magnificent Seven. Obviously, 2 years ago, before it nearly doubled, the PE ratio was much lower, about 30. But also the growth rate was much higher, about 22, 25. That was a much more attractive equation. Now it's about half of what it was in terms of the PEG ratio. So you're paying a lot more for a lot less growth. Not a good equation. Whereas the 493, you're paying a big discount to the growth rate, about 8 times PE ratio. That's way below. It's like 70% below, and you're getting a growth rate that's close, 9% instead of 13. So that's looking at it in terms of earnings momentum. Now, what's going to cause this again to go over the catalyst? Well, we have onshoring, industrialization, a broadening of the economic recovery, and rotation from these large mega cap Magnificent Seven stocks to equal weighted and value stocks. Next slide. conclusion. So this trade, shall we call it, where if you wanted to get really aggressive as a hedge fund, that's kind of what we do. We are long the 493 side of that equation, and it's even more magnified when you look at smaller stocks. Micro cap and small cap, which is where we do a lot of our research, are even cheaper than the green bar I showed you. So we're long that part. We're owning those stocks, and we're selling the Magnificent Seven. We think it's at nosebleed valuations. The catalysts we mentioned are coming. There's other catalysts developing now as well, which will lead deregulation. That's the next thing in the pipeline by the administration. The tax bill that has to now get through the Senate, and the enormous amount of treasury bonds that have to be refinanced. That right now, to put that in perspective, about 30% to 35% of the total amount of treasuries are being refinanced. And that can cause interest rates to go higher short term. That is a negative for high PE stocks. They do poorly when rates go higher. Low PE stocks do better. And so that's another catalyst, the treasury financing. So that's the equation. Looking at kind of an asset allocation situation, and we're seeing this already this year. The Magnificent Seven is starting to underperform. I think year to date it's flat at best. The things that are working are the lower value trades that we're talking about. You've got international markets doing well. International markets trade at about a 30% discount to our S&P right now, so it does make sense. You've got small caps that are cheap. They haven't worked yet because there's a fear of the economy. So this is making sense. The allocation is to go into also natural resources as an inflation hedge, and they also are cheap relative to their long-term needs. So I'll be back. Right now, we're going to do our three ideas to focus on. And first up, we have our minerals and strategic metals analyst, Jim Rohn from Canada, to share two ideas with you. So is there for Jim? Hey, Jim. Okay, Chris.
Great. Welcome. I trust that you can hear me clearly. I see Chris, you're sharing the screen. You can either share the screen, Chris, or I also have it on my PC, so I can share my screen. So whatever works best.
I'll make you the presenter, Jim. Then you can easily.
We did see it. You had it right.
Okay, how's that? Can you?
If it was better before.
You might need to zoom in a little.
All right, I'll try that.
On the bottom right there, yeah.
Yeah. Better?
Maybe a little more.
How about that?
How's that, Robert? I think that's pretty good.
If you can expand it on the screen, maybe it's me here. Hold on. All right.
Looks good.
Better?
Much better, yeah.
Great. So I'm ready to begin whenever you're ready.
Go for it.
Yeah, okay, great. So welcome everyone. My name is Jim Maroney. I am a research analyst with Singular Research. I do cover the mining and resource sector, My background's a Bachelor of Science in Geology, and I also have my MBA in CFA. And so I'm going to present to you two ideas on two companies that we cover. They're both in the mining sector, however, two very different commodities. But before I begin, I just want to say thank you to Robert for his great insight with regards to the market. And that is a good parlay into our ideas here in our two names that we're going to present. Because, as Robert said, you know, the great rotation may be out of that Magnificent Seven into other sectors. And one of those sectors may be the resource sector, based on the fact of some points that Robert raised, such as onshoring, as well as domestic industrialization. And this sector too is comparatively undervalued as well. Also, it's a good sector in order to diversify your portfolio. So, you know, resource companies are not companies that you want to invest 100% of your portfolio in, but some small percentage of your portfolio would benefit from investing in the resource sector. It provides a hedge, and not only provides a hedge, but it's also has some very good speculative gains as well. So aside from that, let me get into the details with regards to our two companies that we cover. The first is Power Metallic Mines, and this company is most of its operations are in Quebec. So Quebec is very you know, resource rich. It's jurisdiction friendly, and this is where this company primarily operates out of. Now, this company, Power Metallic, was just recently called Power Nickel. The reason why it was called Power Nickel is because the project in Quebec, the NISC project, was primarily a nickel sulfide deposit. Now, just looking at nickel alone, you might be bullish on nickel because it is a major commodity that goes into electric vehicle. Now, there's some headwinds, if you will, with regards to the EV space, but nickel still is looked at as a bullish commodity. Now, it's changed its name from Power Metallic to Power Nickel because in this NISC project that they have in Quebec, they've come across other smaller deposits near the main deposit, in which it has a lot of other minerals other than the nickel. Most of them are considered, you know, your precious metals, the critical metals that we hear about now lately in the news. Things such as palladium, platinum, and these other precious metals. And as you've been hearing, you know, from a macros perspective, you know, there's less reliance on, say, China with regards to these minerals, and maybe a little bit more of a domestic emphasis. You know, we've seen it recently with, you know, the U.S. trying to strike up a minerals deal with Ukraine, right? So, or even most recently South Africa. But, you know, those are not the only two players. You know, maybe Canada could be also a great player too. Now, you know, Canada is also facing these trade headwinds, if you will, just like other countries around the world as well. But I don't really believe Canada is the target for a trade war with the United States. I think really their target is China. Really, if anything, what will happen, you know, going forward is probably a negotiated trade deal with Canada in which we trade our comparative advantages. So our comparative advantages is the fact that Canada is resource rich. You know, we would trade our resources and in return we get finished goods from the United States. So, you know, that's yet to be seen. But what I want to point out is that, you know, Canada could be looked at as really trade friendly rather than a trade foe. Now let's get into, other than the sector being attractive, why these particular names. So let's start with power metallic. So just as a headline here, we've recently raised our price target from 70 cents to $2.90. We raised it just this past spring as a result of recent developments, particularly with their exploration campaign. And I'll get into a little bit about their exploration campaign over 2024, 2025. And I'll try not to get too technical. I'll try to say it in layman's terms, just so that you can understand, well, why are we bullish? Why did we raise our price target? Why are we issuing a buy? And things to that nature. So I'll skip the recent news. Let's just get into the actual report itself, and particularly the maps, because the maps will tell you all. But before we get to the map, just as an introduction, Power Nickel, what was once called Power Nickel, is called Power Metallic, again, to reflect the fact that it's not only a nickel miner, but it's also a miner to these rare minerals, which will likely be more in play going forward. And so looking at the map here, what this is showing you is Lion Zone and the Tiger Zone. Now this is within the NISC project. This is a very small scale area of the NISC project. I'll show another map, a much larger map, where it encompasses all the deposits. But what this map is showing you is the most recent results, which were issued just back in March, and it's based on those results in which we raised our price target. So there was 6 drill holes, and the results of those 6 drill holes that were released in March. 4 of those drill holes were in the Lion Zone. 2 of those drill holes were in the Tiger Zone. And if you see in the graphic below the assay is basically a core, you know, the results of the rock after they've drilled. And what the assay showed was that there was high concentrations of mineralization, particularly these rare minerals such as platinum and palladium. So this is what we call a polymetallic deposit, because it's not only nickel and gold, but also these other rare minerals. Now, what you would just want to take away is that the results showed heavy concentration. So not only is the mineral there, but the grade level was there. Okay, so grade level is there, the amount is there, and the deposit's showing great anomalies. In addition to the drill results, you know, a lot of these mining companies back up their drill results with geophysical surveys. So basically they'll overpass the area perhaps with, you know, electromagnetic surveying or radar. And what, you know, the geophysical results show is that, yes, they've identified, you know, a deposit, an anomaly underground, and these are the areas that, you know, are very likely to show results if you drill. So that's what really the rest of the report is just illustrating, just a little bit about the company, what they plan to do over 2025 and 2026. They're going to continue drilling. They're going to continue doing geophysical surveying and other geophysical work like borehole, electromagnetic surveying, and airborne surveying as well. So let's go to the next map. And what this is showing you here is they're really showing you up the top right corner, the line zone that I had just showed you with those 4 drill holes. And to the right of that line zone is the Tiger zone. And you could see that it's pre-printed there, polymetallic. So again, the polymetallic just refers that it's more than just nickel and gold. We also have these rare minerals as well. Now, we have EM survey, which means electromagnetic surveys. We also have done gravity surveys. Now, the gravity surveys encompass a much more wider area. And if you look at the wider area and you look down to the left-hand corner, we see the main NISC deposit, which is the big nickel deposit. Now, that's how this company kind of originated 4 or 5 years ago. But what they've done is expand that geographical survey, and they expanded it 5.5 kilometers along the strike. So between the main nickel deposit and the line zone stretches 5.5 kilometers, and the company plans to actually survey that entire area because they believe that this deposit stretches from the main, the NISC main deposit all the way up to line zone and potentially even further into that Tiger zone as well. Okay, so that's a little bit about the geography and the geology.
Hey, Jim, sorry to jump in. We have to get Wabi up here. He's got to run to another meeting in about 5 minutes, and then we'll come back to. Oh, I'm just told he's pretty engaged in your presentation. Good job. But I do want to say, since I'm interrupting, that Jim found we found this stock before they made this big discovery, which is somewhat lucky, but we'll take it. At the time, what was it, Jim, 16 cents a share? Something like that.
Yeah.
It was, the market cap was like 50 million. Now it's 250 million-ish. And it's been really de-risked because they've already found pretty much the resources. Now they got to see if they're even better. That's why this thing's got a lot less risk and still a lot of upside. Anyway, back to you, Jim.
Yeah, great. So should I just finish this up and then pass it over to the other presenter, or do you want me to stop here?
Yeah, no, we've got the uranium stock too. That's why I'm saying we have Wabi.
Right, so you just want me to finish up on this stock, or?
Yeah, go ahead. But we have people that want to talk about the uranium. Maybe you have 5 minutes and wrap up the whole thing up.
Okay, so let me just continue. It'll take me about another minute just to finish. All right. So basically for 2025, 2026, what the company intends to do is just continue drilling and also doing metallic studies, metallurgical studies. So what that is going to do is they're going to send the assays to the lab. They're going to basically do a chemical analysis to really identify, well, how much of each of these minerals do we actually have? So that's what we have to look forward to. So basically this company has a lot of legs because it's going to be driven by a lot of the news cycle associated with this company. So there's going to be a metallurgical study later in 2025, and then early 2026 is going to be an actual resource estimation study as well. Okay, so that will actually quantify, you know, exactly how much tonnage with regards to the deposits that we have there. So near the end of the report is, again, just this geographical map showing you the line zone, the maiden Nisk deposit, and the tiger zone. Again, it stretches for about 5.5 kilometers. What you see is the drill holes that have been already reported. And again, there's more drilling to be continued. More news probably will be released throughout 2025 and 2026. And a little bit about the valuation, if I may. You know, this company is one of those valued resource companies, and we base it based on the amount of market cap this company has in relationship to its resource estimate. So right now, as far as the price of nickel, it's an attractive price point. It's kind of it's had a run up until early 2025. It's had some weakness, so it's actually kind of like an attractive price point right now in terms of the commodity. But we believe that there's a lot of runway still with nickel. Now, the company itself trades at around 28 times. And the average amongst its peers around 22 times. So it's trading around what the industry average is. Now, other comparable nickel mining companies trade from anywhere from 6 times to 54 times. But we apply basically the peer average. And if we apply the peer average multiple, we arrive at a price of 363. Now, like any mining company, there's execution risk. You know, you have all this, you know, this company may have the mother lode, but the risk is, you know, can we get it out of the ground? So there's some execution risk. So we've applied a 20% discount to that 363, and we arrive at a price point of 290. You know, that's a 309% price growth. So again, it's a nice diversifier in the portfolio. You can hit it out of the park if it, you know, continues to do a run up. And you know, we're really bullish on this company. We like its prospects throughout 2025 into 2026 and maybe beyond. So Robert, I'm going to conclude there with Power Nickel, if I may.
Yeah, great. You want to jump into the Myriad real quick and do like a 5-minute on that, and then we'll get Wabi up here.
Yeah, okay, I could do a 5-minute on Myriad.
Okay.
Okay, so Myriad. This is it's headquartered in Canada. However, its operations are in the U.S. side. Its operations are actually in Wyoming, which is really a uranium known state. So yeah, another resource company, but this one is with regards to uranium. But we like it. It has a lot of the same features like Power Metallic in that we find it's kind of undervalued. So we have a price target. It's currently trading at around 19 cents. And we have a price target of 135. Now, this too is based on its exploratory work. You know, we initiated a buy and the price target based on news releases with regards to their drilling and their geological surveying. So let's get into the report itself. Again, I'll take you through an introduction as well as the maps. The maps will kind of show you everything. So we recently provided an update as well around the same time as we did with Power Metallic, because they released their borehole results back in March as well, around the same time as Power Metallic did. And they released the results of 20 boreholes. And what those boreholes showed was, again, same idea, high concentration of uranium, uranium-308. It shows higher concentrations of uranium as well as greater intervals, so basically greater depths of the assays. Now, a little bit of history to this deposit, this uranium deposit in Wyoming. This was actually initially explored by, I want to say Union Carbide, one of the big industrials back in the 1950s and 60s. And what they did was do exploratory work at the time and then basically abandon it. They abandoned it back in the 1970s and 1980s. It was really abandoned right after, you know, some of those events like Easter Island or, you know, the other kind of nuclear incidences, if you will. And so it kind of went out of favor during that time. And then, you know, as we've seen, like the emphasis was later on carbon burning fuels, oil and gas. And now, you know, that kind of has been put a little bit out of favor. You know, we obviously need more power consumption, right? So a lot of these, even these tech companies, are investing in uranium companies and other nuclear related companies in order to provide energy and power to a lot of their data centers and things of the like. So that's a little bit about the macro. Now, it was basically abandoned by that company, Union Carbide, decades ago. This company, Myriad, has then, they were originally operating in Niger, Africa. But as we know, when you operate mining in a foreign place such as Africa, there's a lot of jurisdiction risk, a lot of geopolitical risk. So they kind of abandoned their Niger operations and have recently, just within the past couple of years, invested in this Wyoming deposit. And what they did was take over all the historical data that Union Carbide did back in the 1970s. And now what they're doing is, well, based on that historical data, they're infilling with more drilling. They are drilling deeper. They're actually even re-examining the results. So what they're saying in the most recent results back in March is, well, they've underestimated what the results are. They actually underestimated by 20% based on the recent testing. Now, let me retract. It was not Union Carbide. It was Union Pacific that did this. I'm just reading on my report here. It was Union Pacific that did the initial geological survey and drilling. But again, now Myriad has kind of picked up the torch and re-examined all this historical data. They are drilling themselves, doing a lot of the geophysical surveys as well, much like what Power Metallic is doing. And so basically what the rest of the report is explaining is that they're just going to continue drilling and releasing results throughout 2025 as well as 2026. They are so bullish on the company that they are not only continuing drilling, but they've also expanded their survey area. So they've expanded with renegotiating leases with adjacent landowners things of the like. So what you're seeing on this map here is that they've actually doubled their coverage. So the blue area is what they had last year, and the yellow area is representing their expanding area with lease agreements with adjacent landholders. So this is why, this is another factor why we're bullish. They're optimistic based on drill results. They've expanded their geographical area. And what they're saying is, this is much deeper than anticipated or expected. The concentrations are higher. There's just a lot of tailwind with regards to this project. Now, this is a uranium company, so that's our expertise. They have expertise. They did have it in Niger, they had it in Wyoming, and now they also are looking to New Mexico. So they've recently acquired land claims in New Mexico, really cheap. They acquired it for $500,000 for $525,000 Canadian. They acquired the rights for exploratory work in New Mexico, and so they're going to also commence on drilling as well as geophysical work going forward. And this too, has a lot of legs and a lot of upside should those results come in a favorable manner. Just going to my valuation, same kind of idea here. We are kind of looking at, well, what is the price of uranium? It's kind of at an attractive price point as well. It's priced at around $65 per pound. Myriad itself is very attractive from a market cap to million pounds ratio. It's trading at only 0.3 times, whereas comparable uranium mining companies are trading anywhere from 1 to 35 times. So we applied what Myriad's resource estimation is to its peer average of 9.2 times, and we arrived at a price point of 176. Again, we applied a discount for the fact that it's a mining company. There's execution risk associated with it. So we discounted that 176 to a target price of 135. A lot of upside considering that it's currently trading at only 19 cents. So Robert, that's basically my two ideas, Power Metallic and Myriad Uranium. And I have really nothing else to say other than optimism with these two companies.
Well, yeah, that's great, Jim. It came to the 16 cents a share, and I'll make a little guess at one of these works out and keep me around. I'm just kidding. Why don't you set up there? I've got a few comments here, and in the intermittent time frame here. Do you have coffee? I believe it's true. Somewhere, right? But I want to fill in a couple of spots here that we think about uranium. The announcement today, right? Noon, 1 o'clock, regarding another executive order. I mean, there's a lot of which one, right? This executive order that they're going to be announcing next week, that will create a broad mandate to build more nuclear plants. Think about that. That's the data. That's driven by the demand for AI. But the AI nuclear builders, companies that build nuclear plants, we're keeping out of the market. Uranium benefits this here. That's the likelihood of this species.
I'm not in charge. Oh, I can't.
Bear with me here. We're going to move over to the live presentation. And hold on a moment. I think we're going to close this one, right? Oh, hey, Chris, we need to put on Wabi's presentation. Maybe you can give us some tutorials on how to do that.
Well, let's see. So I'll make you the presenter. I could see on my screen.
You got it? Okay.
So share.
So Wabi is with, I always think it's not saving. PROP, Prairie Operating Company. We cover it, and we, Wabi's trying to report from someone else that also covers it. Justin, Houston.
Yes, we have so far Johnson and Rice, Clear Street, and Piper Sandler.
And still kind of early, I think the oil companies have 7 great analysts, but operations for we can turn it over to Wabi, right from Houston, tell us about Prairie. Yeah, Wabi.
Thank you. Said my name's Wabi Plogsma. I'm with the Prairie Operating Company. I head their investor relations and capital markets. On the tables, there's a hat for everybody if they'd like. And then we have research coverage there from, like I said, Clear Street, Piper Sandler, and Johnson and Rice. Targets ranging from 9 to 13. We currently trade around $3.50 on the NASDAQ. Citibank is our lead in our credit facility and syndicate. And we have a very strong banking group, which I believe all will start to pick up coverage. So you should see additional research reports from institutions in the near future. So with that said, we need to go into a disclaimer. We are a public company traded on the NASDAQ under the symbol PROP. Would make forward-looking statements. So if you need some bedtime reading and can't get to sleep, feel free to run through that forward-looking statement. So as I said, Prairie Operating, we are a oil and gas company in the DJ Basin of Colorado. We have just under 50,000 net acres. To give you an idea, that is larger than Miami. So a very large position in the DJ Basin in Weld County. We are offset, meaning our neighbors, our fence lines are some of the largest oil and gas companies in the world, Chevron, Occidental, Civitas. They literally share fence lines with us. And we are in a very, the population density in these areas is very low, so we're not gutting up against schools, neighborhoods, or anything like that. It is literally prairie land, hence the name of the company. We have about 500 plus locations to drill, about 160 permitted locations. That gives us about 10 years of drilling inventory. At a rate of 1 rig per year, a rig can do anywhere up to 60 wells in a year. They drill them incredibly fast. Anywhere from 4 to 6 days can drill a 2-mile lateral. It's incredible. I think Occidental hit a record in drilling 2-mile lateral in 24 hours. We are a growth company. That is what we are focused on right now. Free cash flow that we generate will go right back into the drill bit to continue the growth in production. We will eventually become a dividend provider. I would anticipate that being in probably years 3 and 4. Our goal is to get to about 100,000 barrels a day of production. We would then kind of plateau out. Our maintenance CapEx would keep us at that. Excess cash flow will be in the hundreds of millions potentially, which we would then distribute to investors either through share buybacks, special dividends, or a consistent dividend. What's really interesting and I need to point out here is that our management team is very deep experience. Prior, one of our founders, he sold his last company for $2.5 billion, which equated to a 10x return for his shareholders. So I'm asked why the DJ Basin over the Permian. We find the DJ Basin to have comparable and favorable economics to most other basins, and similar type returns. The Permian, I know everybody wants to be there, clamors to be there. It is expensive to get in there, and it is a higher operating cost area than us. In the Permian, you tend to have a 6-to-1 water to oil ratio. So you can kind of make the joke, sometimes you're a water company out there that has a byproduct of oil. You do have to dispose that water. That's an increased cost. In the DJ Basin, we're about a 1-to-1, so it lowers our cost. We don't produce much water, but we have similar and I would say comparable returns to the Permian in the DJ Basin. Our financial strategy, we're very prudent with it. We want to maximize everything that we're doing. Prior, you would take a drilling and completion cost would cost about $7 million. And that's because you would go to one service provider. They would have everything bundled for you from chemicals to sand. We have taken that and we have decoupled, debundled everything, which we will go source our own sand. We will source our own chemicals. And that's taken our cost to drill and complete a well down from 7 million to 5.5. And we are targeting to be sub 5 million as we continue on. All that does is move our returns much higher. We are also very focused on capital efficiencies when it comes to leverage. We are minimally levered. We are currently at about 1x on a leverage ratio. What's gotten small cap companies or even mid cap and large in the past has been over levering, and then oil prices take a hit, commodity prices can be volatile. That is something we will be avoiding, as you can see with our targeted leverage ratio and what we currently are at. That can be offset with an active hedge program. We put out a press release not too long ago stating that we had hedged 85% of our 2025 production at just under $70 a barrel. So right before Liberation Day, we had hedged out our production. So that drop in commodity prices, while it took our stock down, we were locked in at just under 70. For 2025, for 26, 7, and 8, we're around $65 on gas and around $4.15. Excuse me, I'm gonna flip. Around $65 on oil and about $4.15 on gas. We produce the cleanest molecule. So the DJ Basin in Colorado is one of the most regulated environments for oil and gas, just behind California. I say that if you can operate successfully in the DJ Basin, you can operate anywhere in the US and other basins successfully. We have an exceptional team in place that can handle all regulatory aspects in the DJ Basin, which is why we say that we produce the cleanest molecule. In the DJ, you cannot flare, you cannot truck, so you have to mitigate those factors. That leads us into your midstream and takeaway capacity. We have locked in firm takeaway that will see us through our entire development program. We put that in prior to our latest acquisition, and it's on an escalating scale. So once we hit a production milestone, we unlock additional capacity, which then allows us to continue drilling and growing into everything as we go. That we, in the DJ Basin here, we are in an oil-rich position. We're about 70% liquids, I would say around 60-ish% oil, so very heavy oil focused, which is what we are targeting. As I said, very friendly in rural Weld County. Interesting, fun little fact tidbit. Weld County actually tried to secede to Wyoming because they wanted a more oil and gas friendly environment to drill. The vast majority of tax revenue in this county comes from oil and gas. So that provides funding for schools, police, fire. So they are very oil and gas friendly and pro, that they would like as much drilling as possible in Weld County. So our organic strategy is to grow about 10% through the drill bit, but also to grow inorganically through M&A and acquisitions. That is, I would say, clear apparent. In our latest one that we just did, it's basically a minnow swallowing a whale. We were a 150 million market cap company that took down a $600 million acquisition of Bayswater that added around 25,000 barrels a day of production to the company. So we will continue to look for inorganic growth. The first acquisition we did with Nickel Road, we did at just over 2 times cash flow. Bayswater was around 2.5 times cash flow. If you can take an asset on the private side and then put it into a public vehicle that trades at 3 to 4 times, you have an instant private to public arbitrage and an uplift in value that you can recognize by doing that. So we will always look for accretive transactions, which we feel we have a very robust pipeline to look at. And our management team, our board, we're all very large shareholders in the company, about 10, 11% after this acquisition. So we are very cognizant around dilution. And to be honest, we make money when the stock price goes up and are highly aligned with our shareholders with that. As I said, we are focused on growth. Our free cash flow that we generate in the early years will go right back into the ground to continue drilling, growing our production profile, extending out our location so that we always have about 10 years of inventory to develop into. And we'd like to, get to about 100,000 barrels of production before we then start looking to distribute cash flow to shareholders. This just gives you an idea of the high quality inventory and the duration that we have. As I said, we're always looking for 10 years, and this is how we've achieved what we have to date. I had our experienced management team, hundreds of years of experience in oil and gas from Chevron, SM Energy. We have on the banking side. So we marry the finance and the industry side of things. And we have, like I said, about 11% ownership in the company right now. Just want to kind of bring it all together. As I said, company highlights here, why we feel that Prairie is an incredible opportunity for folks. We are in a highly oily and contiguous position in the DJ Basin in Weld County, which is a very low cost operating environment, but with highly predictable and high returns. This is not exploration, this is exploitation. The oil is there. It's just a matter of how and at what cost you bring it out of the ground and how efficiently. We are targeting double-digit organic growth with low break-evens. Our break-evens in this area are around $40 a barrel. And as I said, we've hedged 85% of our production, just under 70. We do have an active and robust acquisition pipeline. I believe it's about $2 billion that we would like to go target. Again, it has to be accretive, has to be at the right price. We are very aware and cognizant of dilution to our shareholders, given how large shareholders we are. On the midstream side of things, we have everything in place for our growth. As I said, we stair step into capacity. So we're never going to be, in my opinion, shut in or having to hold back production to get it to market. And we're going to be very prudent on the finance side, very strong balance sheet, minimally levered, as we currently are, about 1x on leverage ratio. And we look to grow this company and then at some point eventually be distributing cash to our shareholders. So, with that, I've put research reports from the 3 that cover us on the tables. My contact information is here. This is my cell phone number. So if you ever have questions, comments, concerns, you have my home number to call me. And I'll answer any questions at any time for you. So with that, thank you so much for inviting me and having me present.
Thank you. Well, last month was a high bar, but I think we got some potential. While we're getting ready for the home stretch, yes, question. In the back.
I have a question. Do you have competitors with other oil and gas? Like we could cover. Do you have competitors with other oil and gas? I do love your stock. I'm very already with uranium. We also cover, or you're totally separate? Your cost.
Just have a problem. The last P, what does that stand for?
The last P. Currently operating company.
Part of the symbol.
Oh, yeah. Oh, yeah. Yeah, it's cool. Yeah. Thank you.
Right at this time. To develop, we've already had the neighbors that are already producing.
We also check on so that is an equal responsibility. They are the least times. So we have one of the founders.
I'm agreeing that courthouse is foreclosures and real estate. Sure.
Kind of means so that you have a lot of infrastructure. Doesn't it already there in place? It's not like you're pulling out.
No,
Trying to develop.
yeah, this is not exploration. This is exploration.
Fantastic. Thank you, Wally. Melanie, very good opportunity. By the way, I think, as is our practice, we were one of the first or second firms, I believe, to pick up coverage. We were the first. Look at 3 more firms after us at higher prices. That's how it works here. Thank you again. Yep, profit taken. Good entry point. Insider's buying. Yeah. Terrific. Yep. Okay, for the home stretch. Chris, can you get me back on the last part of the presentation? Chris, are you there? Chris.
Yeah, hi, Robert.
Hey, Chris, can you cue me back up? Do I need to do anything here? Hopefully not.
Let's see, where are you at? This one?
Am I supposed to
This
find
one?
it here? I don't see anything on the screen here. Let me see. What am I doing wrong? Great session. Okay.
You need to
I need
go
to
back
get
to open up the GoToWebinar.
that. Have a great session. Okay. 2 windows over. That one? Okay. Am I joining back in? Maybe. Join back in? Probably.
It says you're already here. You're already in. But I'm presenting.
Okay. Where do we go to see the slides? I think it's here. You just got to whip up the slides.
Open up the GoToWebinar, or at least click on the GoToWebinar program.
It was at the bottom. Now it's at the top. We're good. We're live. Okay, we're back. We're going to just kind of breeze through the strategy that we use at Argonaut. Next slide, Chris. Argonaut. Jason and the Argonauts sailing to get by all the beasts and the risks and de-risk them and slay them so that we capture the golden fleece. Next slide. Because it's a tough world out there. All right, so we look to outperform by finding companies before ground and diversifying and holding them for the long term. Generally, it comes down to companies that lack coverage are underfollowed and underpriced, usually by 20 to 30%. Rinse, repeat, that's our edge every time. We are not operating on anything but profits here with this fund. No investment in me. A little bit about the relationship. Argonaut is connected to Singular Research. I'm the principal of both companies. Singular Research is the driving catalyst of the fund. That's what we invest in. We don't. A little bit about my background. I graduated, fell off the turnip truck, ended up at Morgan Stanley. Wow. Then got a better deal at Smith Barney. Then we started our own company, and where we are today. We learned with the best, and now we're implementing it on our own. And with Singular Research created shortly thereafter. Next slide. 35 years now. This slide's 5 years old. Okay, next slide. 11 analysts. We really have 6 right now. We are bringing on 2 new analysts, healthcare and biotech. 2 out of favorite segments right now. They're all afraid of this guy, this new Maha guy, but we think they're going to come back. Next slide. The market opportunity. This just shows the difference between companies that have coverage, which has the gold on top, and companies that don't. This is a courtesy of the New York Stock Exchange, showing over years of research the difference in pricing. It's just better advertised, better followed, higher price. We look for companies like Wabi's company that are underfollowed. Next slide. That's the wheel of fortune. All starts with research. Next slide. Where do we get our ideas? Well, dartboard is one. Okay. Proprietary screens. We have our own databases. Past coverage. Analysts have a long pedigree. They've been around. They know names. They know where some interesting companies still are. And then finally, market intelligence. You go, hey, look, they're putting in a top golf over here, and nobody's there. Is that good or bad? Well, we don't know. But a better example would be they're building a data center or a Tesla dealership. That's market intelligence. Believe your eyes when you see that happening. Next slide. This goes into some characteristics of what we look at for a long and what we look at for a short is pretty much the mirror image. Companies we like are cheap. Companies we don't like are very expensive. Next slide. Yeah, more on that. Next slide. Yeah, portfolio construction, 20 to 50 names. Our competitors, out in the fund world are big mutual funds like Fidelity and Franklin. Not to put them in, they have, because they have so much money, they have to have 100 stocks so they can invest it all. So they don't blow their names up. We're nimble. We're like leading the market. It didn't happen below the market, and we get a and then when you get that's what was risk 500. Why bother? What it comes down to, if you get a stock that doubles and it's 5%, there's 5 points. If it's 1 out of 100 or 200, excellent. Market being 12 months is probably half of the battle. Are we right about the direction of the market or not? So we try to pay attention to that. It's important. So we use all this deep research, looking at all these macro, monetary, fundamental market behavior, technical indicators, and score it. Right now we are bullish. Next slide. All right, we use ETFs to hedge. We want to protect our portfolio. We think the market's going down. We don't try to pick which stocks go down most. We'll just short the Magnificent Seven, P, or a sector that's overvalued to get in there quick. Next slide. This shows we're a very small fund. These are some of the terms. It's a 1% management fee, 20% incentive allocation. All that means is that really, as one of the largest shareholders in the fund, I'm meeting the same. Our objectives are aligned. I don't really make much money unless we all make money. That's the idea. And there's an incentive to do that. Next slide. Appendix, next slide. My background, let's see, we covered that initially. Next slide. I've been examined by the SEC thoroughly, and I'm still here to talk about it. I got what's called the we had a campaign to go after smaller firms. They have different agendas. We somehow came into their by chance a radar screen. So it was like sitting under the bright lights with 2 investigators and all that, but we got what's called a no action letter. They don't give you the good housekeeping seal of appeal. They just say no action. You can leave now. Yeah. So we did. Returns. We have had a lot of good years. One bad year, 2022. That was a bad year. It happens. It doesn't always go up. But mainly good years. This year, we're down just a little bit, but we're starting to make some headway. I think we're going to end up having a pretty good year. The tariffs, put us on our back a little bit, but like if you were here last time, we think the tariffs really long-term are a good thing. Next slide. That's a chart of what we're talking about. Basically, we looked at compound long-term, somewhere in the mid-teens, and it really adds up over time, and it kind of shows that. The blue line is us. Go down a little bit versus the indices, Chris. Argonaut at the end of last year, 18.8. Russell P HFRX index, which is really our category, hedge fund research. That's our category, and we're quite a bit ahead. Next slide. This just shows we had a good year last year with 39%. Next slide. Yeah, this goes into our sector. This is, we've changed this a bit now. We're underweight technologies, not overweight, because of what we just went through with the Magnificent Seven. Next slide. Historical examples, let's go quickly. Next slide. Roku, that was kind of like the parking lot example I gave where it's full. I actually myself walked into a Best Buy and I go, look at all these smart TVs, who makes them? What's operating them? It was all like, the first computer. Oh, Windows is on all the computers. At this time, Roku is on not as many, but a lot of them. So we looked into it. It was undercovered, and it was a nice stock. We bought it at 40. We held it for a long time, over a long 43 years, and it went up to 400. Next slide. Price Smart, they're like a Walmart, except they're in the Caribbean. They're like a Costco. Next slide. Stamps.com was a near virtual monopoly. They had the franchise from the USPS. I'll tell you, if you can find a monopoly and it's not too overpriced, put a lot of money in it. It's not a lot of competition. That was kind of the case here with Stamps. And so that was another nice return, 70 to 280. And they went private. They liked themselves so much. They go, hey, market, see you later. We want to sell to ourselves. Next slide. Here's one that didn't work. That happens. And this one, it was just a case of a bad idea at the wrong time. And we got out before it went way down, but it did go down, and it did work. I hardly remember it. That's why it didn't work. Okay, next slide. This is showing the research coverage list return versus the benchmark for small caps, which is the Russell. And so it's just the value of over time compounded returns. It makes a big difference. Next slide. Yeah, this shows back at the time we were bearish not too long ago. And we use our indicators from that other slide I was going into about the aggregate indicators. And so we use this to trying to get a bearing on how bullish or how bearish or neutral should we be. That's about half the battle. Next slide. That's it for this one. Now for the really good stuff, stick around here. That was good stuff, don't get me wrong, but I really like this next slide. This kind of drives home some of the things in your mind where you think this is a tremendous investment. Next, and it's a good investment, but It's just the power of compound returns. Chris, can you go to slide section 7? Here we're going to look at non-stocks as well as stocks, as Chris is pulling it up. I kind of came across this in a conversation. We were talking about professional sports. And
Wait,
how the
Robert,
power-
is this the PowerPoint? Which one is this one?
It should be called the power of long-term or investments. That's the title of the slide.
Investment growth comparison?
Yeah. That sounds like it.
Okay.
So we're talking about how, oh my God, this guy's getting $40 million a year just for throwing a ball around, right? I mean, that's insane, right?
This one?
Yeah, that one. So we took a look at that. That must be just amazing. Let's take a look at what the highest salary was 50 years ago and what it is today versus values of other things like the stock market, kind of compare. So go down to the next slide. We kind of compare a dollar invested. So we looked at the Dow Jones, the New York Yankees, and baseball pitchers, and the Argonne Fund, just hypothetically, if I wasn't in like junior high school, I had a hedge fund at the time, what I would have done if I had these returns over time. Next slide. Here's the Dow Jones, which over the last 50 years, or since 1973, has averaged 7.35. Next slide. This is the top pitcher salary. 52 years ago, it was someone called Tom Seaver. If you're a baseball fan, you know Tom Seaver. The number was 175,000. That was like the big number. Today, it's a guy in the Phillies named Zach Wheeler. He's getting 42 million. So we thought about, that's ridiculous. He's got to be making just tons of return. Well, it's pretty good, but it's 11.77, right? So then you think, well, who's making all the money in baseball? Is it the players or the owners? Next slide. Or sports, for example. I think this should probably apply to football. But I think baseball has got the best negotiators and the best agents. You missed the slide. That's a good one. But get back to the Yankees. So the Yankees were bought by a guy named George Steinbrenner in 1973. He paid about $9 million. Today it's worth $9 billion, 1,000-fold, right? You think, well, that's got to be 30% a year, some ridiculous number. Well, it's 11.66, compounded over 52 years, right? So we're all going to live to be 100 at least. Think about that. You're going to need to get a good compound return. Next slide. With all this healthy food we're eating. All right, this is the Argonne Fund. This is our compound return since 2019, 16.45. That's as of, I think, last month. So if George Steinbrenner had put his money with me when I was a teenager and I had a hedge fund and I was doing this strategy, all these hypotheticals, if he put his money with me instead of bought the Yankees, would he be better off? Oh yeah, because this compound rate equals 25 billion, threefold. 11.7 versus 16.5 over 53 years. Oh my Lord. Last slide. Compound long-term returns. This just shows what I just went through, and that is the Argonne Fund outperforming the New York Yankees and the baseball pitchers and the Dow Jones. Okay, let's go to the very final slide, I promise. This would be the closing slide, number, I don't know, maybe 9, Chris? Oh, yeah, I covered all that already, really, so you can skip that. No, next, it's a new slide. It's the last one in the series. So,
Hold on, what? I don't have another slide.
Oh, are you sure? It might say sale. the slide that says sale. Do you not have it? Okay. So I
Is
made
it a
this nice
PDF?
slide. It's a PDF, yeah. It's on the email, the same email. But anyhow, Chris is pretty good. He might find it here when I'm talking about it. For new investors, we're offering an incentive to get started with us. And that incentive is if you invest by the month of June, the minimum ask, we'll give you 30% off the management fee. There it is. I knew we'd do it. That I made that myself with AI. Pretty good. All right. Well, thank you, everybody. That concludes our presentation. Let's the weekend begin. Thank you very much. Any quick questions?
Hello.
To answer the question, I think we're going to have a door prize too, because everyone wants to give you their business card, and we'll have a drawing. One question that I
think if we Dave wins it again, we'll have to come up with something else. He won it last time.
One question I would love to ask is if I have another
Did you get the table behind you?
portfolio manager, like if I have Richard and people come to me and say, well, portfolio manager, can I invest in your fund? Even if I'm investing already?
Well, we're not on Richard's platform yet. We're working on it. We're so small. We're so small. We're like that Harrison Ford trying to get his first gig and he's still building houses. That's where we are. We're not on these platforms yet, but we hope to be, at least on one or two. We don't have a worldwide plan of domination, but we would like to grow. Yes.
Just going back to earlier in the what we say is potentially going to be funding that growth level. Is it that a lot of these companies are potentially going to buy they wisely?
I think I missed the first part of your question.
What's in terms of like how are these companies grow or basically
The 7 or the 493?
The 490.
Yeah. Well, they're going to fund their growth the hard way because they don't have those huge amounts of cash that the Magnificent 7 have. That's one of the big benefits, particularly in a recession. One of the risks is you can run out of money or things get tough. They have plenty of money, so that's the big moat, the big cash. So it's going to vary, on an industry basis, Richard. Companies right now, the balance sheets in general are pretty good. Not a lot of leverage. The balance sheet that we're worried about is the government balance sheet, quite frankly. That's like now at historical leverage levels. So I think that's a normalized time we're at now.
Regarding the
Yeah.
A lot of the mining industry wants consolidation. Are those companies going to see that? And the other question is, find that the first companies and there's new discoveries that they are they going to have to put a lot of capex managing process that?
Okay, so a few parts of that. I'll try to unpack it. If I miss a couple, just remind me. Starting with the last part first, which is the only part I remember right now. But that answer is those two companies are highly speculative companies. They have very limited resources, so they will be coming back to the market to sell more stock. Now, the Myriad Uranium company is minuscule. It's like 10 million. So to get to the actual production of that, I don't think that's their end game. Their end game is to say, hey, we found it. Come and buy us out. Here it is, rather than go through all that minutia. With power nickel, it might be a little different because they have found something already. And that stock was probably at the Myriad uranium level before this find where we picked up coverage. Now it's significantly de-risked, and they're also in a very infrastructure rich area where they're in Quebec. They're next to a big, body of water, a lot of electricity, hydropower. A lot of things are very good for them, so they can produce this stuff. I think they're going to go it themselves rather than they may do a partnership with a large major or a midi, but I think they have enough, and they just raised 50 million too. So that one, power nickel, is a less speculative play, and maybe Maltbie has an answer for his company in terms of ongoing funding, to develop. You seem like a big cash flow generator right now.
Yeah, we're targeting 300 million for 2025. So we'll fund drilling cash flow. We also have an RBL with the city united that is up to $1 billion.
Line of credit is pretty big time. Okay, what was the other parts of those questions? I'm sorry.
Yes, it was, actually, I pretty much
We found these ideas through our analyst, Jim Maroney. He's up in Canada, and when he's not drinking Molson's, he's actually wandering around these fields. I'm kidding. He's got a lot of degrees, very smart guy. One of his degrees is in geology. So he's more than a financial guy like me. He actually's got real knowledge. No, finance is kind of real knowledge, right? What does Trump call people like hedge funds? Oh, a bunch of guys pushing a bunch of papers around the outside to get a real job, right? He's got a point, But who just put a big buy recommendation on the market? Trump. A couple times. He's saying, let's go buy this market. I'd listen to him. There's a ton of cash out there. Some of it will go in those bonds that we're talking about. But this guy who runs not a small shop, Black Rock. There's a couple there's Blackstone, but Black Rock is the king of the rocks. It's run by a guy named Lawrence Fink, and I think they have all the treasury options too, but they run maybe better than $1 trillion themselves. He says the world is aflush in cash. There's 11 trillion here just laying around in money markets. And in Europe, another 12, and he hasn't even gone into Asia yet. But I'm sure that's probably more. So to put that in perspective, the total market value of all equities globally, right, is about 180 trillion. So that's almost 20% of the equivalent in cash. A little historical perspective, normally it's 7-8%. So there's a lot of fear out there. Still looking for that trigger.
Also, you really recognize that we go to market because especially the money market is kind of like almost 20%.
Yeah.
We mostly yield 5
down 4 and headed lower. If you have to go, feel free. But I do want to say that I believe that short-term rates are too high, and Powell needs to wake up. But I won't bash the good chairman much, except to say the historical parameter there is plus 70 basis points over Fed funds, right? So I mean, not Fed funds, the Fed interbank borrow rate. What do we call it? No, LIBOR. It's not. They changed it. It's not LIBOR. SOFR with an F. SOFR thinking. So 70 basis points over short money. Short money is really more like 3 right now. It's down. So rates should be at 3.7, 3.5, a bit lower, a little bit lower than where they are now. More like 3, I think, in a year. That's where they're going to be. All right, that'll conclude it. Any further final questions? Let the weekend begin. Thank you, everybody, for coming out. Oh, a door prize. Door prize will be a year of research subscription. The retail price of that is 10 to 30,000 with the institutions that I just bashed. This isn't right. It's Dave. John. John. All right. Give us your personal email. We know that one doesn't work. Thank you, Chris. Jim, if you're still around, thank you very much. Thanks a lot, everybody. Good night.